The parent company of the failed Silicon Valley Bank is now seeking Chapter 11 bankruptcy protection. SVB Financial Group filing is no surprise in light of its subsidiaries' collapse. Its venture capital and broker-dealer businesses are still operational and are not part of the filing. SVP Capital and SVP Securities are still prized assets, according to the company's chief restructuring officer. Overall, SVP Financial Group says it has $3.3 billion in unsecured debt that could get wiped out in bankruptcy. The proceedings could eliminate even more money in stock, and the trading of its shares stopped on Thursday. And joining us now to further discuss the recent bank failures is president of the Krivaric Capital, Tony Krivaric. Tony, good to see you. Thanks.
Good morning, Jason.
That was a lot to unpack.
Yes.
Break it down for us. Now, it's been a week now. What do we know, looking back at the last week, what do we know today?
Basically, you had a bank that made some poor investments, and when that kind of word got out and depositors found out about it, they started, pulling their deposits out of it, and the bank didn't have enough deposits to pay everybody out. So it's important it's a risk that's no bank has all of their depositors' money just sitting in the back somewhere in case everybody pulls out their money. So I'll give you an example. In a hypothetical example, let's say 10 people put $100,000 in each into a bank, so now there's $1 million. The bank's not going to have $1 million just sitting in the back somewhere. They're going to invest 800,000 of it or so to make a profit, to lend, to make loans and so forth, so they can then pay their depositors. So if all those 10 depositors show up at the same time and say, I want my $100,000 bank, no bank can do that. So that's one risk that we run in this kind of social media world. If rumors get started on the internet, if everybody shows up, no matter the bank, there won't be enough money to get all the money out. Now, that doesn't mean that the bank is not a good bank, because the investment that they've made should equal more than the deposits that people have. It's kind of like, I'll give you another analogy. If you have a gym that has 2,000 members, how many machines do they have? They don't have 2,000 machines. They have 50 machines, because that's in the normal course of business. 50 machines is plenty. So if you come and you're the 51st person, you have to wait a little bit. So the second risk is that when you tally up all the money that the bank has, it's not enough to cover all the depositors. And that's what FDIC insurance comes in and covers each and every American per person, $250,000, regardless of bank.
So there must have been people who were in the know and saw this coming and pulled their money out? Are we hearing about cases like that?
Silicon Valley Bank was a very specialized bank. They dealt with a very specialized clientele, high-tech millionaires and billionaires and entrepreneurs. This wasn't your mom and pop bank. So they had very concentrated type of depositors. And when the rumor and pretty well-informed customers. So when the rumor started there, like, hey, these guys are making some poor investments, everybody started pulling their bank, and they did not have a diversified base. And now the bankruptcy person is going to tally up, see what the assets actually are in there, and they made some risky bets. And so that's kind of what caught them. These are very heavily regulated entities, but that just goes to show regulation can't stop everything. And that's why, for the peace of mind for the average American, the government guarantees $250,000. Once the bank has their charter, the government says you'll never get less than $250,000 out.
Okay, so there's no reason for our viewers to be really worried unless they've got more than $250,000 in a bank.
Per person, per bank.
Okay.
And one of the trends that's going on right now is this applies to every bank, whether it's a large bank or a small bank. And so one of the fears that I have is that people are moving all their money from smaller local community banks that actually live and work in the community and serve the community. People are moving their money to the larger banks in a thinking that they're safer or so. But if it's a regulated bank, your local community bank is just as safe as the large bank. And we have this whole Walmartization, Amazonization of America that wiped out a lot of small businesses. Now we have local community banks and credit unions that are at risk because people have the often wrong impression that these aren't safe. And in some way, you want your local bank because they know you, they know local businesses.
Sure.
Big mega banks aren't going to lend to a local sandwich shop and so forth. This is too small for them. So we run a risk. We have to preserve our local and small community banks. And so it's important for people to understand, if the local bank serves you well and you have less than $250,000 per person, there's no risk in keeping your money with your local community bank. I think we need them, and we don't want just end up with 4 big, woke corporations that are mega banks that couldn't tell you from the next person.
Well presented, Tony. That was really, really great. I know a lot of people were confused, but no need to worry. You're good up to 250,000.
Absolutely.
Stay
So
local.
the main thing is don't panic. This is because these things can feed on themselves.
Sure.
And like I mentioned, no matter the bank, if everybody shows up at the same time, wants their money, it's not going to work. That doesn't mean that the bank is insolvent. It just means it's not set up for that way. Banks deal with cash flow just like you and I deal with cash flow in our daily lives. And so it's important to keep that in mind.
Okay, Tony Kravach, thanks.
You bet.
Appreciate it, Tony. All right, coming